So, negative equity on auto loans has become a very serious problem and widespread for borrowers and consumers. And there's a lot of conflicting messages out there from dealerships, from lenders, from auctions, a lot of different places. Fortunately, there's some great sources from unbiased government agencies. You have the Consumer Federal Trade Commission, you have the Consumer Finance Protection Bureau has a report, and you even have the USA Educational Foundation. And we're going to take a quick look at all of them so you can get straight answers on what to do with negative equity on your car loan. The first one will go quickly just because it's short and it won't get into a deep dive rabbit hole. The Federal Trade Commission talks about auto trade-ins and negative equity when you owe more than your car's worth. This is, common for most people. The funny thing is, many of these articles talk about data from the 2020, 2021, or even 2019 era, where they were talking about 3,000 or 4,000 in negative equity as a big number. The negative equity figures we're seeing has gone up quite a bit since then. We're seeing many car loans with negative equity in excess of $10,000. $8,000, $9,000, $10,000 is very common. Most people would love to have $3,000 only of negative equity because that's a lot easier to deal with. So you'll see that number thrown around. So when you see 3,000 or 4,000, that's because it's a little bit historical data. It talks about how car dealers sometimes will advertise that if you trade in your car, we'll pay off the balance of your loan. Well, that's true. They will pay it, but it's not out of their pocket. They just tack it onto your new loan. It's called rolling it into your new loan, and FTC calls it misleading. What is negative equity? We know what that is, how it works with a trade-in. Here we go. Your old car is worth $15,000. You owe $18,000. That means you have $3,000 negative equity. Most people would jump at having only $3,000 negative equity. How to tell if your negative equity is part of your car loan? You'll see that it's added in. It'll be itemized. You want to look at it. It also says how to deal with negative equity, and this is great, but most people don't want to do any of these. I'm sure you don't. Wait to buy another car until you have positive equity. Well, yeah, you could do that, but in the meantime, you still are stuck with those payments on that old car. It also might be that you don't like that car anymore. It doesn't work for you anymore. Maybe you have kids and you need a bigger car. Maybe you need a truck. Number two is you could sell your car yourself. Might get more for it than it's worth. Well, yes and no, but if you have a loan on the car with negative equity, you can't get the title to give to a buyer because the buyer's not going to give you the cash until you give them the title. You can't get the title until you have the cash. So it's unrealistic to do that. However, there are some buyers that are not trade-in type dealers, they're resale dealers that can do the loan payoff for you. And we'll talk about that, and you can see it on our website. Ask a dealer how they'll handle negative equity, and they'll tell you, we put it onto your new loan. Negotiate your new loan for the shortest amount of time you can afford. Well, that's great, but the shorter you go, the higher your payment. For most people, the reason you want to get out of your old loan is because you can't afford the payment. So if you go shorter term on your new car, your payment's going to be even higher. So that defeats the whole purpose of it. So what else does the government tell us? Here is a very insightful deep dive on negative equity. We won't go into the whole thing, but there's some key points you need to be aware of as a consumer so you don't get burned and stuck with credit and financial problems. So this is a report from the CFPB, Consumer Finance Protection Bureau. We've talked about them before. They have a lot of oversight into car financing and car selling. Many of the techniques we use for loan exit are CFPB Cars Act requirements for dealers. So this is a powerful bureau. One of the things that comes up in this is what happens to you if you have negative equity. Well, here's some key stats. Consumers who finance negative equity from a prior vehicle loan onto a new loan were more likely to have their account signed for repossession. Meaning that if you roll negative equity into a new vehicle, you're more likely to default on your new loan. Okay? Consumers who finance negative equity into a new loan had monthly payments 27% higher than consumers with no trade-in. So if you roll your negative equity into a new loan, even if you can do that, your payment's going to be a third higher. So if your payment would have been $800, it might be now close to $1,000. That's why you want to exit your old loan before you get your new loan. As soon as you roll that into the new loan, that money's gone. If you exit it first, you can cancel and kill that negative equity and then get your new loan free and clear. Consumers who finance negative equity had lower credit scores. Well, that's going to happen if you have excessive debt. You want to get rid of that debt so you can raise your credit score. You have higher loan to value, but that only makes sense because your loan is going to be higher than what it would have been without negative equity. Here is another troubling statistic. 25%, a quarter of consumers financing less expensive vehicles finance negative equity into their loan. So people who bought cheap cars, a quarter of them had negative equity. But people who bought more expensive cars, 50,000 or more, only 16% had negative equity. So the more sophisticated buyers, the more qualified buyers didn't put negative equity into their new loan, right? So this is where a loan exit makes sense, so you can afford a higher vehicle and have a better financial situation. And the percentage of negative equity is larger for consumers who bought cheap cars. So if you buy a cheap car, you're more likely to have a higher percentage of upside down on that new car. And it has a lot of statistics to back all this up. There's some graphs about listing price for used cars, how it went up in 2000, depreciation, how much vehicles depreciated. There was only 1 year where there wasn't a lot of depreciation when there was the supply chain issue from pandemic, but other than that, depreciation is a big deal. Consumer loan characteristics, talks about negative equity trade-ins, how much the value was. It also talks about loan term. Loan terms have gone up. Loan terms right now are averaging 73 months. That's 6 years plus. Many loans are going to 7 years, sometimes 8 years now. Consumers who finance negative equity finance larger loans, meaning more interest, higher payments, higher average payments, paid higher interest rates. So not only do you pay more interest, but your rate is higher, and that rate is applied to that whole loan. Lower credit scores, longer loan terms, because when you have that higher balance, you have to stretch it out more to be able to afford your payment. And here's a breakdown of the negative equity. Now remember, this is from a few years ago, but if you look at the amounts, you're looking at, here's 5,000 negative equity, is kind of where the average is, 3,000 to 5,000. Well, this is a few years ago. Now, the average negative equity is 7,200. So that's shifted up here. You can see even just a few years, this graph has shifted up here, and a quarter of them are more than $10,000. So their conclusion from all this, like we said, if you finance a negative equity, you're more likely to default on your new loan. If you have a lower income and lower credit score, you're more likely to finance a negative equity, and it's going to make your credit score even worse in the future. Also, it says that with financing transactions with negative equity, additional consumer stress if economic conditions change, which they are. So you want to make sure that you're preparing for the future and not financing your negative equity if you can all avoid it. And that's where a loan exit makes sense, so you can separate your old car from your new car. If you roll your negative equity into your new car, you're just poisoning your new car. Everything you hated about the financial situation of your old car, now you're just putting that poison into your new car loan rather than separating the two. Even if there's a little bit of pain, you get that over with, and you're not burying yourself in your new car before you even drive off the lot.